Imagine two people standing in the same economy. One has cash in the bank. The other is buried in debt. 5 years later, the person with debt is richer, more powerful, and harder to ignore. The saver did everything right and still fell behind. That sounds backwards. It feels wrong. But this is not a glitch. This is how the system actually works now. And once you see it, you can't unsee it. Right now, debt is treated as a problem in public, but as an asset. In private, governments run on it. Banks depend on it. Markets reward it. And cash, a thing you're told to protect, quietly loses relevance. So how did we get here? How did owing money become more valuable than having it? And why does this matter more today than at any other time in modern history? Let's start with a simple truth we rarely say out loud. Cash just sits. Debt moves. Cash waits for opportunity. Debt creates it. That difference used to be small. Now, it's everything. Go back a few decades. Debt was expensive. Interest rates were high. Borrowing was risky and painful. Cash, on the other hand, paid you. You could earn real interest just by holding it. In that world, saving made sense. Debt was something you escaped from. But the rules changed quietly. Not overnight. Not with a big announcement. They changed through policy, crises, and temporary fixes that never went away. After every major shock, wars, recessions, financial crashes, the same response repeated. Lower rates, more lending, more liquidity. Debt got cheaper. Cash got weaker. At first, this looked like help. Lower interest rates meant cheaper loans, easier mortgages, more growth. But there was a second effect that mattered far more. When interest rates fall, existing debt becomes more valuable. Why? Because debt is a contract. If you borrowed at 2% and inflation runs at 5%, the math tilts in your favor. You're paying back money that's worth less than what you borrowed. That's not a loophole. That's the design. Now zoom out. When this happens at scale, across millions of borrowers, debt stops being a burden. It becomes leverage. Leverage over assets. Leverage over time. Leverage over the future. Cash can compete with that. Cash does not grow by itself anymore. It erodes. And erosion is quiet. You don't feel it day to day. You feel it years later when your purchasing power is gone. This is where the system flips. The saver thinks in terms of safety. The borrower thinks in terms of access. Access to assets. Access to opportunity. Access to growth. And the system rewards access. Let's talk about banks for a moment, because this is where the misunderstanding usually starts. Banks don't love cash. They tolerate it. What they value is lending. A loan is not money leaving the system. It's money entering it. When a bank creates a loan, it creates new money. That new money earns interest. It circulates. It multiplies. Cash sitting in an account does none of that. So banks are structurally aligned with debt, not savings. They pay savers as little as possible. They court borrowers aggressively. This isn't greed. It's incentive design. Now, layer in inflation. Inflation is often described as prices going up. Datese, de surface. Underneath, inflation is the system choosing debtors over savers. Every year, inflation exists. Debt gets lighter. Not erased, just diluted. If you owe a fixed amount, inflation works for you. If you hold cash, inflation works against you. That's why the phrase real returns matters more than most people realize. If your savings earn 3%, but inflation runs at 6%, you're losing quietly. No headline, no alert. Just math. Now here's the uncomfortable part. The people who benefit most from this are not reckless borrowers. They're structured borrowers. Governments, corporations, large asset holders, they borrow cheaply, deploy capital, and let time and inflation do the rest. Debt becomes a strategic tool. It funds growth. It inflates asset values. It shifts risk forward. Cash holders don't get that option. absorb the cost. This is why housing prices explode during low-rate periods. It's not just demand. It's leverage. When borrowing is cheap, buyers can bid more without feeling it immediately. Prices rise. Assets inflate. Debt gets locked in. Years later, the asset remains. The debt shrinks. In real terms, that's how debt turns into wealth. Now, contrast that with cash. Cash doesn't scale. You can't lever it without turning it into debt. You can't protect it without exposing it to risk. And in a system built on perpetual credit expansion, idle cash is treated like a missed opportunity. This is where the irony sets in. We teach people to fear debt, but the system itself is addicted to it. Publicly, debt is framed as dangerous. Privately, it's the engine. Governments run deficits as a baseline. Corporations roll debt indefinitely. Markets price assets, assuming constant credit availability. Debt isn't expected to disappear. It's expected to roll forward forever. Cash, on the other hand, has no role in that loop. It doesn't generate fees. It doesn't grow balance sheets. It doesn't expand influence. So it's quietly Now zoom out even further. When debt becomes more valuable than cash, behavior changes. Risk tolerance rises. Time horizons shorten. Speculation becomes normalized. Why wait and save when borrowing lets you act now? Why hold cash when assets are inflating faster than wages? This is how bubbles form without anyone feeling irrational. Everyone is responding logically to the same incentives, and when the system works, it rewards that behavior, until it doesn't. Because here's the trade-off nobody likes to talk about. A debt-based system is stable until confidence breaks. As long as people believe future income will cover today's borrowing, the machine runs. But when growth slows, when rates rise, when inflation becomes unpredictable, debt flips back into a burden. Suddenly, leverage cuts both ways. Cash regains importance, but only after damage is done. That's why cycles feel brutal. The system trains people to behave one way, then punishes them for it later. So where does that leave the individual? Caught between advice built for an older world and incentives built for a new one. Saving feels responsible, but responsibility isn't rewarded the way it used to be. Debt feels dangerous, but avoidance isn't neutral anymore. This doesn't mean go get reckless. It means understand the terrain. In modern finance, money is not just about amounts. It's about position, where you sit in the flow of credit, how early you access capital, who absorbs inflation, and who benefits from it. Debt isn't automatically good. Cash isn't automatically safe. Their value depends on the system surrounding them, and that system has quietly chosen sides. So here's the unresolved question. If debt keeps gaining power, if cash keeps losing relevance, and if the entire structure depends on confidence continuing forever, what happens when the next generation stops believing the rules still work? Because systems built on leverage don't collapse loudly. They drift, until suddenly, they don't. And by the time the value of cash matters again, the game has already changed.